TJ and I had an impromptu episode we wanted to film, and that's because the Fed came out today and they announced what is happening today and then some commentary on what is to be expected in the future. It's interesting and really not what we had hoped for. So let's dive into the details. Welcome to Loans Elevated. Fed comes out and they cut rates like expected. And what we were hoping for was the ending of quantitative tightening. Mm-hmm. And there's some arguments from very trusted resources of ours, like Barry Habib, who says they did technically end quantitative tightening. However, they're still selling off mortgage-backed securities. They're no longer selling off treasuries.
But the selling of MBS is still not good for rates.
It's the worst thing for rates. It's creating the artificial supply into the market, which is a problem.
And that's what nobody talks about. The headlines are all going to say it's a 25 basis point cut.
Within 30 seconds, I had a text message from a client that says, rates came down 25 quarter point.
That's what mine said.
Can we get a lower rate? Or are we stuck at this rate? Rates didn't fall a quarter point.
Well, in fact, rates have gotten worse by almost 0.1% in our rate sheet.
Yeah, rates got worse today.
Yes.
Even though the Fed cut. Now, and we've just like gone haywire on this idea that Fed rate cuts do not mean lower rates on mortgages, and Fed rate hikes don't mean necessarily higher rates on mortgages. It's a much more complicated beast, but it's more like the why behind what they're doing. So why are they cutting rates? What is the reason? What is their justification for it? That is what causes rates to change. But the big thing we were hoping for, like I said, was them stopping the sell-off of mortgage-backed securities, which they're not stopping. They're going to allow mortgage-backed securities to continue rolling off their balance sheet as they mature. Now they're no longer going to just increase the holdings, cash holdings. Mm-hmm. They're now going to reinvest this into treasuries, which I guess is good for treasuries, which maybe downstream could be good for mortgage-backed securities, but it sucks because what we were banking on when they made that announcement a few weeks ago, which we did also mention on Loans Elevated as well, was ending quantitative tightening could be a huge lift for mortgage rates, because if they stop selling off mortgage-backed securities, there's less supply. If there's less supply and the demand remains consistent, which there's no reason it shouldn't, then there should be an improvement to rates because the supply and demand metrics change. Now, that's not happening, which really sucks.
Yeah. Saw another headline, too, that said the Fed decides to cut rates despite not having data because of the government shutdown.
Right.
They didn't have data, which I think is kind of ironic because the Fed doesn't really have data anyways every time they do it because the data is never accurate by the time they're making their decision when it comes to jobs.
Yeah.
So that's really a moot point. Thought it was interesting that a headline would come out with that.
Headlines are headlines, and it's so obscenely obnoxious. Mm-hmm. Now, some details as to why the markets are moving. So mortgage rates today, Fed cut rates. Fed kind of stopped some version of quantitative tightening. At the surface, you would think that's good for mortgage rates. Mortgage rates are worse today. We're having a worse day today than we've seen in at least...
It's got to be over 90 days.
2 to 3 months.
Yeah.
Like, it's a bad day today, and thankfully we have some good support. But why is that happening? And this has everything to do with what the Fed's tone is to the markets. So after the Fed makes their decisions, the tone and the additional kind of reading between the lines or even part of the actual lines about what is happening next is what really causes mortgage rates to react. And what we heard today was Jerome Powell coming out and saying, it seemed like every other sentence was, there is no certainty we're going to continue dropping Fed funds rates. It's not a foregone conclusion that the Fed funds rate is going to go lower in December because there is dissenting opinions in the meetings with the Fed governors that some don't think that they should drop and some think they should drop more. So the issue is now the market at large is saying, okay, well, what are you saying? Is there data we aren't aware of that is causing you to believe that inflation's going to be worse or that employment is better off than we think? Now there's all these question marks. And remember, if inflation goes up, mortgage rates go up and borrowing becomes more expensive because investors demand a higher return on investment to keep up with inflation. So now there's all these question marks based on the Jerome Powell's comments. Now, it's no mystery that Jerome Powell and President Trump are like fighting as like politically correct as you can fight. They're fighting as bad as it could be. And, you know, is this posturing in that regard? Is this him flexing his muscle like Trump, you can't control me? Like, that's what I question. Is some of this politically charged?
Yeah, I don't know about that. It's interesting. I also find it interesting that this decision was made just 24 to 48 hours after Amazon announces that they're cutting off 14,000 jobs.
14,000?
14,000 jobs.
Wow. When? Like immediately?
I don't know the details on that. Maybe you can look it up.
Wow.
But which I also find is weird about this is Amazon is highly profitable. They're not showing losses.
So was it AI driven?
There's been some speculation. I've heard through the DMs that there's some expensive, and this is total speculation, but I've heard that there's some AI chip that they're looking to purchase, or chips they're looking to purchase. That could be it. I don't know the reasoning, but it is interesting to see that we're seeing more layoffs from large companies, the largest in the U.S., and that would then lead to uncertainty in cutting rates. I mean, it seems like that with layoffs seems all the more certain to cut rates.
That's crazy. So let's see. Trying to
Is that accurate, the 14,000?
Yeah, 14,000. And our guess here was right. In one of the headlines from Business Insider says Amazon is cutting 14,000 corporate jobs to be leaner in the age of AI. So it is AI driven.
Yeah.
It's part of a broader plan that could eventually impact 30,000 corporate roles. So this is corporate. This isn't delivery people. So we're not going to get a bunch of drone deliveries yet, it doesn't seem like.
Yeah.
But
nonetheless, 14,000 is a lot of people.
Well, and I think the more important piece is, which it's like, we are living in a revolution of our economy. Like we're witnessing it before our eyes, because she says we need efficiency and startup like agility. So Amazon, one of the largest companies in the world,
wants to go lean and mean.
Yes. And be able to be more agile. And AI is disrupting the ability for the American person to be employed. Now, that's been the fear, which it's like, holy cow, we're seeing it happen. Well, I guess what opportunities come from that?
And the other thing, too, is, okay, we've got corporations that are going to be profiting from this, but that doesn't equal a better economy overall, right? Because now they can go slimmer, more lean, more mean. What does that mean for the American people? Like that?
Yeah, I mean, we're a consumer economy. If
right.
they're not employed and they don't have money to consume,
right?
Yeah, that's not a good thing.
So I just find it weird that they knew that data going into the meeting today. You'd think that would sway some sort of decision one way or the other.
Well, and it's interesting because it's so silly. So Jerome Powell, in his commentary, which, just so you're clear, that's what matters. It's the commentary and the perception of what it means.
Yeah, you can
commentary.
You can look up the percentage odds of what the cuts are going to be. That's damn well. It's so effing accurate. We see it time and time again. Okay, we damn well know they're going to cut by 25 bips, or they're going to cut by 50 bips, or they're not going to be doing anything.
In advance of the actual day.
Yeah, so the actual announcement has no bearing on the markets.
The official decision, right?
Yeah, exactly.
It's more of the commentary. So he says in the commentary that they're looking at certain data points because they don't have access to the jobless numbers because the government shut down. And again, he was pretty kind of in your face about that being one of the reasons. So that's one, like, part of this seems politically driven. It seems like he's got like something to prove a little bit. But he says we can't get that, but we are getting the some other report that they get every single week. That is still continuing despite the government shutdown. And that is the, I believe, initial jobless claims. So they're compiling that data and making their best guess on that data. But then he says we're looking at Indeed and we're looking at job postings. And neither one of these data points that are available despite the government shutdown are telling a story. There's no story. And he's like, so for that reason, we don't really think that employment is that big of a concern. However, with the tariffs, again, political jab, it seems to me, with the tariffs, it may not continue, or it may not be a one-time thing. And so we've got to balance this approach, but we feel like there's more risk in near-term inflation. So that's kind of what freaked the markets out. Yet he's not looking, so he's looking at Indeed.com, which is a bunch of probably inaccurate job postings, because I'll bet you we have job postings for our team on Indeed.com. We're not actually hiring right now. So it's kind of a flawed view, but he's not looking at the announcement yesterday from Amazon that's factual, that they're cutting 14,000 jobs. If you're going to use an anecdote, you got to use an anecdote both directions. And I think that's why the markets are freaking out.
Yeah, you're saying one thing and doing the other, in a sense. The thing, too, is, and this is more your job role than mine, we've got almost 20 staff members. When's the last time that we actually used Indeed for hiring? We've got stacks of resumes.
Exactly, for sure, exactly. But the point is, we probably have a posting on Indeed just because.
Yeah, for sure,
It's just always there.
So either way, it's not accurate.
No, yeah, exactly. So I don't know. That's crazy. But maybe to provide some clarification, this is something that I thought would be helpful. So it's clear what is moving rates today. The Fed announcement, we got kind of what we wanted, but unfortunately not the right bucket of what we wanted. So I thought it might be worth maybe just quickly summarizing. Okay, you have the Fed rates. And we've talked about this a bunch of times. Fed rates are not mortgage rates. They're actually not connected directly whatsoever at all. However, the Fed rate is directly connected to your credit card, your auto loan, your HELOC, and all other types of consumer-type debts. So there's a lever they can pull depending on what the economy's doing, which is Fed rates. So they can drop Fed rates to make borrowing cheaper. This also affects banks and their ability to be more nimble in the marketplace. So that affects the rates and the overnight borrowing for banks, which affects consumers somewhat because there's a bunch of consumer debt that it does improve. So you got rates, and when they hike rates, the opposite occurs. But then you have this thing called quantitative easing, which we had years ago for many years, and you have quantitative tightening. These two things are the Fed manipulating their balance sheet, the holdings of assets they have. Quantitative easing, they go and buy a bunch of treasuries and they buy a bunch of mortgage-backed securities. And they effectively, by the purchase of assets, pump a bunch of money into the economy. If there's more money in the economy, just like we said, there's more ability for the U.S. consumer to spend, more ability for the U.S. consumer to invest, and the economy heats up and heats up and heats up. Quantitative tightening is the opposite of that. They start selling this stuff off, or they terminate the purchases, and then they start selling it off, and they start selling more off. So quantitative tightening is essentially sucking that money back out because everyone's continually spending, and they're no longer funneling the money in that everybody got used to. And so those are the two things that
So in the COVID area, we're seeing QE.
Exactly.
Because so much spending was happening. That's what led to the inflation.
Right.
Now, the past couple of years, we've been in QT.
Right. Yep.
And we're seeing the fruits of that labor now.
And it's paying off. And years ago, we talked about this in one of our market updates. You can find it here on the channel. But we talked about how long it takes for the measures in quantitative tightening to actually affect the economy. And it just wasn't it just barely starting to peak in the effects like in about a year ago?
Yeah.
And those sustained effects from decisions they made 18 months prior were just peaking a year ago, and the sustained effects continue well into now.
Yeah, and you had a really good analogy. I don't know if you remember it, but you said it's like having a doctor having a patient that's in severe pain from an open wound, and you start pumping it full of morphine. Well, they don't immediately feel the effects of that morphine.
Right, they're like, it's been 10 seconds.
Yeah, it's not
more.
Yeah. Well, now they could have flooded it, and they could have overdone it.
And kill the patient.
And kill the patient, yeah, which can kill the economy. And that's what our fears, you and I's fears.
And I think there is and we've kind of been doom and gloom on this for a while, but I think there is a tsunami of risk coming from that issue because, and the Fed is like stubbornly unwilling, despite so many economists squawking at them, like, you've got to figure this, like, we've got to cut rates. There's a myriad of reasons why. You've got the federal debt. That's a critical component.
Yeah, so that'll come back early next year.
Right. You've got the risks. We're still in the government shutdown, right?
Yeah.
I mean, you got the risks of employment being a problem, and obviously more now because AI is becoming a real disruptor.
Even with profitable companies. It's
like one of the most profitable companies in the world is laying tens of thousands off.
Yeah.
That number, that 30,000, was like 10% of its corporate workforce.
Oh, wow.
Crazy, right?
Yeah, that is gnarly. I didn't realize that.
So, yeah. Anyway, to me, they're overcooking it. We've been saying this a long time. We're not economists. We're just mortgage guys trying to do our best. But it is disappointing.
I think a good resource, though, if this is something you guys want to look into more, Broch did a good blog post about this, about what controls interest rates and whatnot, and how they actually work.
We've done 2 of those now.
Yeah, on loanselevated.com, go to resources, you'll find it.
Yeah.
And we'll link in the show notes as well. But it's a really good read, just so you can kind of digest, wrap your head around it, and always refer back to, because you're going to see this again in December. You're going to see, and maybe not, who knows, based on what Jerome said today, but maybe they cut, maybe they don't, but you're probably going to have these common questions again. Go back to it, keep it on hand, and always refer to it.
Yeah, 100%. So that's the scoop. That's why rates are getting worse. We'll obviously keep you abreast of things changing, and hopefully we start seeing some improvements, or at least this doesn't kill the improvement and the path we've been on with mortgage rates, because they have been getting better. But yeah, that's it. Thank you for tuning in. Please share, share, follow, comment, do all the things. Check out loanselevated.com for more info.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.